The S&P 500 has become extremely concentrated, the most concentrated stock market in U.S. history. So I thought it would be helpful and a good idea if we took a look at the top 5 holdings of the S&P 500, looked at their concentration levels, and compared the current concentration, 2024, against the last major concentration event, which was the year 2000. Just to see how much more concentrated are we in 2024 versus the year 2000. We're also going to take a look at some other important metrics like PE ratio and market cap to GDP for the top 5 holdings of the S&P 500. And this will help give us an idea of just how overvalued or not are we presently, and what kind of returns can we expect going forward for both the top 5 holdings of the S&P 500 and the S&P 500 as a whole. So let's get into it. As of November 2024, the top 5 names in the S&P 500 are NVIDIA, Apple, Microsoft, Amazon, Meta. These 5 companies have a combined market cap of $13.4 trillion. That represents a 46% market cap to GDP on our $29 trillion economy. The average PE of these 5 companies is 41 times earnings, expensive, and they have a combined weighting in the S&P 500 of an astounding 26.5%. NVIDIA alone is 7% of the S&P 500, and Apple is right on NVIDIA's heels at 6.9%. This is concentration like we've never seen before in the history of this country. Now let's take a look at the concentration in the year 2000. In January 2000, the number 1 holding in S&P 500 was Microsoft, followed by GE, Cisco, Walmart, and Exxon. These 5 companies at that time had a $1.9 trillion combined market cap, which was only 19% market cap to GDP on our, at the time, $10 trillion economy. The PE ratio of the group was much higher, 81 times earnings, and that's largely because of the influence of Cisco at 198 times earnings. The concentration was only 15.6%, a lot less than November of 2024. If we remove the outlier PE from the group, Cisco, the average of the remaining 4 comes down to 52 times earnings. Now, we all remember what happened after the bubble burst in the year 2000. We're looking at the S&P 500 price graph. We see it peaking about April of 2000, and then for the next 13 years, no appreciation on price for the S&P 500. We were in a very overvalued stock market, and it took a long time to bring that valuation down. We had 2 very serious drops along the way as a result of recessions. The recession of 01, the gray bands on this chart are recessions, and the recession of 08, drops of 49% and 56%. Let's see where we were by January of 09 in terms of market cap to GDP, price to earnings ratio, and concentration for the top 5 holdings of the S&P 500. In January of 2009, the top 5 holdings of the S&P 500 were Exxon, Walmart, Procter & Gamble, Microsoft, AT&T. They had a combined market cap at that time of only $1.1 trillion, down significantly from the $1.9 trillion that the top 5 holdings of the S&P 500 made up in the year 2000, 9 years prior. The market cap to GDP for the top 5 holdings was only 8%. Notice that GDP had grown. GDP is now at 14 trillion in January of 2009, but we had come down in price significantly for the top 5 holdings. And what's really intriguing is the PE ratio. So this is the market bottom, right? And the PE ratio is only 12 times the average PE for the top 5 holdings in the S&P 500 in January of 09. The concentration is down slightly to 14.5%. This was a back up the truck moment for those who had cash to invest. Since the bottom in 2009, we have had 16 incredible years of a bull market for the S&P 500. We went from a very undervalued situation in 2009 to an overvalued situation for large cap growth stocks in particular in late 2024. Where do we go from here? Bull markets don't go on forever. They eventually end and give way to bear markets. We're looking at the last 7 decades of data for the S&P 500. Bull markets are shown as green arrows, bear markets as red arrows. What becomes very clear is that the last 2 major bear markets have been over a decade in length. And I'd like to point out that preceding the bear market, at the transition point where we moved and we crossed over from a bull market to a bear market, we had very high PE, very high valuation, and lots of speculation in the stock market. That was the environment in the late 60s and then again in the late 1990s. Where are we at now? We're probably, I think, late stage bull market, and we have a very high valuation, especially for a certain segment of the stock market. We're probably looking at much more muted returns for the S&P 500 as we go forward. So what kind of returns should we expect from the S&P 500 over the next 10 years? I think that the returns for the stock market are going to be held back by these concentrated names. When you have over 26% of the index is just in 5 names, and the PE is very high, and the market cap to GDP is absurd, off the charts, I don't know how these companies can perform anywhere near what they've done in the last decade. Now, that doesn't mean that they won't make money. I think they could, but I think that the return experience over the next, say, 7 to 10 years is going to be a lot less than the last 10 years. So that means it's a great time to start looking for other areas of the stock market to invest. What other areas of the market can provide a growth opportunity over the next 10 years? And what kind of valuation do they trade at? I would be looking at small caps, dividend payers, value companies, and international emerging markets. That's where the opportunity is. You're likely over the next 10 years to get better returns from those areas of the market than you will from the large cap growth stocks that currently dominate the S&P 500. As we've reviewed in this video, the last 2 bear markets were preceded by a big run-up in large cap growth, concentration in the S&P 500, high valuation with respect to PE. And that's exactly where we're at now. So, like I said, I would get ready, I would prepare for lower returns, specifically from large cap growth stocks over the next decade, and be thinking about how can you realign your portfolio for the years ahead. I hope this video was helpful. I hope it gets you thinking about your investments and overall improve your family's financial plan.